Look, your parents can leave you the house in a will. The family can actually agree who should receive it, and there may be hundreds and thousands of dollars in equity sitting behind that exact front door, and the entire situation can slide into complete chaos before anybody actually understands who's legally allowed to take control. Not because a Michigan bank found a secret loophole. The danger is obviously and most often much quieter than that. The mortgage payment keeps coming due while the family is planning a funeral, searching through filing cabinets, waiting on probate, and getting transferred between departments at a servicing company that refuses to actually discuss the account with anybody. That gap is where the control begins to disappear. A bank does not need to steal your inheritance when confusion, missed payments, and family hesitation can do the damage for them. Today, I am showing you how this actually works, why a will may not actually be enough to keep the process moving, and what your family needs to actually organize before a paperwork delay ever puts the home at risk. Guys, this is general education and definitely not legal advice, but Michigan estates can follow different paths depending on the type of deed, type of mortgage, trust, will, and family structure. So you do need a qualified Michigan estate attorney to actually review your specific situation. Start with a very normal Michigan family, guys. The mother owns a home. It's worth $320,000. She still owes about $65,000 on the mortgage. Her will leaves everything equally to her 3 children. That looks more like $250,000 in gross equity before selling costs, repairs, taxes, and other state obligations. Everyone assumes the house is protected because the will is rather clear. Then she suddenly passes away. One child starts handling the funeral, another relative believes the mortgage comes directly out of her checking account, and someone else has the will, but nobody can remember which attorney actually prepared it. The automatic payment starts to fail after the account holding all of the money is closed, restricted, or has been depleted, and then a letter arrives at the vacant house. Nobody opens it because nobody's checking the mail. Another payment date passes while the family debates whether to keep the property, should they sell it, or should they just let one of the siblings move in. And guys, at this point, the house has not been taken, the inheritance has definitely not vanished, but the clock is running while nobody has both the information and the authority required to actually manage the asset. Michigan law generally provides that a person's personal property passes at death to the beneficiaries named in a will or to the legal heirs when no one controls the transfer. That property remains subject to estate administration, creditors' rights, family protections, and other lawful claims. But here is the Mitten Grip reality check. You can inherit the owner's equity without inheriting a house that is free from every obligation. The mortgage survives, property taxes continue, insurance always needs attention, and winter does not wait for probate before the pipes begin to freeze. A will tells the legal system where the property should eventually go. It does not make next month's mortgage payment. It does not secure the building or give every family member permission to actually access the private loan account. Michigan calls the person responsible for administering the estate the personal representative. Being named in the will does not always mean that type of authority is active the moment the owner dies. A representative generally must qualify through the court before receiving the formal letters that establish the appointment. Now, that distinction catches families completely off guard. They know what the deceased owner wanted. The bank wants that documentation. Intent and authority are not the same thing. Guys, send this video to the person your family expects to handle the house, because that person should not learn the difference while a payment is already late. Now, imagine one of the children calls the mortgage servicer. You get your statement every month. You're going to call the servicer, right? It should be easy. Just tell them the story. You go ahead and provide the borrower's name, the address, and the date of death. And then the representative on the phone says they cannot release any information. To the family, that sounds like the company is hiding behind bureaucracy. From the servicer side, you are a stranger on the phone that is requesting access to another person's loan. The bridge between those two positions is called the successor in interest confirmation. Federal mortgage rules actually recognize certain people who receive an ownership interest after events such as the death of a relative or joint owner. Once the servicer confirms that that person's identity and interest in the property, the confirmed successor generally receives many of the servicing protections provided to the original borrower. but confirmation may require a death certificate, deed, will, trust document, court order, or letters of authority, depending on how the ownership was actually transferred. The servicer cannot reasonably demand the exact same package from every family because not every property passes through the same legal route. Federal guidance states that the documentation requested should be reasonable for the specific situation. Do not expect vague instructions to finish everything and then call back someday. Ask for the required documents in writing, identify yourself as a potential successor in interest, include enough information for the company to actually locate the account, request a written explanation of what they need to confirm for your status, because federal servicing rules address certain written requests from potential successors, which gives you a stronger record than another undocumented phone call with a completely different representative while you're getting the runaround. Now, guys, save every response. Record the reference numbers to those conversations. Keep proof of anything you send. This is not paranoia. Mortgage servicers have created truly real obstacles for successor homeowners, including confusion about assumptions, repeated documentation demands, and pressure to refinance loans that families believed could actually continue. The CFPB documented these complaints actually back in 2024. That does not mean every institution is trying to just steal the house. It just means that you should not walk into this process assuming that the first answer you receive is one, complete, or even two, correct. Now, we need to kill one of the biggest myths surrounding inherited property. A lot of families believe the mortgage company can call the entire balance due the moment the borrower dies. Now, federal law actually blocks lenders from enforcing a due on sale clause in several protected residential transfers, including a transfer to a relative resulting from the original borrower's death. Other protected situations can include certain transfers involving a spouse, children, joint tenants, or tenancy by entirety. That information matters because it prevents the transfer itself from automatically denoting the mortgage in a qualifying situation. But it does not erase the loan. The lender can still respond when payments are genuinely delinquent. This is where a legal protection becomes dangerous when people only understand just half of it. Your family may be protected from acceleration based solely on the inheritance, yet the normal monthly obligation can continue marching towards default. The bank cannot necessarily punish you for becoming the owner. It can enforce a valid loan when nobody actually pays it. Probate is not the predator in the story for most of the time, guys. Disorganization truly is. A clear estate plan with inaccessible documents can still fail in practice. Substantial equity trapped behind family conflict can deteriorate while everyone argues over the final decision. Even the right beneficiary can lose valuable time when the recorded deed tells a different story than the family originally expected. Pull the deed before there is a crisis. Find out exactly whose names appear on it and how ownership is actually held. And if you don't understand it, you need to ask somebody. Then locate the current mortgage statement, because the company collecting the payments may be different from the actual lender that originally made the loan. So don't go look for the closing documents. You need to find that monthly statement. Your decision maker should know where to find the insurance policy, the property tax records, utility accounts, estate documents, and the loan information. Nobody needs a 3-ring binder labeled My Death, but they need a system that works for the person who normally handles everything when they are no longer there. And if your family has already dealt with this kind of process, please tell me in the comments where the paperwork stalled. Was it the court appointment, the deed, the mortgage servicer, or was it something nobody ever even expected? There is one loan type that changes this urgency literally the moment of death. A reverse mortgage does not follow the same playbook as a traditional mortgage. After the final borrower dies, and after any applicable protections for a co-borrower or ineligible non-borrowing spouse are considered, the loan may become due and payable very quickly. For many federally insured reverse mortgages, heirs who receive the due and payable notice may only have 30 days to decide whether they will buy, sell, or surrender the property. Although extensions sometimes can be available, guys, keeping the home may require paying the balance off, while a sale involving a debt above the property value may be resolved under rules tied to the 95% of the appraised value rule. Guys, that is not the time to begin looking for the loan documents. Your family should know well before your passing whether the property carries a traditional mortgage, a reverse mortgage, home equity loan or home equity line of credit, any unpaid tax balances, while you're still alive and actually able to answer those questions. Another threat appears when several heirs inherit things together. One sibling wants to keep the house because it has been in the family for 40 plus years. The other wants their share of the equity yesterday. And nobody has calculated that what it would actually cost to pay off the existing mortgage, repair the property, and buy out the remaining beneficiaries. Sentiment tells the family to keep it, and there's obviously good reason, but the math says the person moving in cannot carry it any longer. Dragging that conflict through months of missed decisions does not preserve the legacy. Sometimes the strongest way to protect an inheritance is through a deliberate sale before the property ever becomes too distressed. You choose your timeline. The family prepares the house properly. Offers can be evaluated without a foreclosure deadline hanging over the kitchen table, which is the worst time to sell a property. Selling voluntarily is not the same as losing the home. The real defeat happens when indecision gives the timeline to the lender, the tax authority, and an insurance problem or a major repair that nobody actually ever planned or funded for. So what should happen after a death? Well, first, secure the property. Find out whether the mortgage is current or confirm how and when the next payment needs to be made. Contact the insurer because of a death, vacancy, or change in occupancy may affect what the company needs to actually know. When probate is required, begin the process of establishing the personal representative instead of waiting for a creditor to create an emergency situation for you. Michigan law also allows special personal representatives in certain circumstances to collect, manage, and preserve estate property before the broader administration is ever complete. That is a legal tool for situations requiring prompt protection, not a substitute for poor planning. Nobody should sign a new deed, mortgage assumption, refinance, or family buyout agreement because somebody on the telephone or representative from the lender says it's the easiest path forward. First, determine what the existing loan actually allows, then confirm who owns the property. After those facts are clear, contact a qualified legal and financial professional that can help the family choose the correct move. The dangerous version of this story is not a bank kicking down the door the morning after the funeral. Reality is much more frustrating than that. A payment quietly fails. Important mail keeps coming to an empty house that nobody's checking. And the person named in the will has not received the proper authority. A servicer's requests of documents that family seems to not be able to locate, and then weeks disappear while everybody believes somebody else is handling it. By the time the family sees the whole board, the position has already weakened. Michigan banks do not need a hidden probate loophole to claim valid rights under an unpaid mortgage. Your protection comes from knowing the rules before grief, paperwork, and financial pressure actually begin to collide. Review the deed, locate the loan, choose a capable, and I mean a capable decision maker, and make sure your family knows which documents establish authority and where those documents are actually stored. Your home may become the largest financial asset you ever leave behind. Do not leave it sitting inside a legal fog with a payment clock attached. Stay prepared, protect your property, and keep your grip tight, Michigan. Subscribe for more Michigan ownership issues that deserve a clear explanation before they become way too expensive.